Hello guys, mkoaje? Eh, ni Ernest Masharia. Na leo tuliahidiana we shall meet again for the advanced level guys. And this is our first lesson. So kwanza sitawachosha sana. Najua nyinyi mko na experience about kasneb. So to me sitawachosha sana. I'll have just introduce a small bit of advanced management, financial management, and tuguzaguze kidogo, halafu tutaendelea baadaye ama siku ingine. So tafuta kalamu yako, kitabu, we take some few notes, and I just want to remind the CP 1 and 2, 3, 4 waendelee kusoma hizo notes zenye tunaandika. They are much of help to you. So, do you have your book and a pen? Tuanze our class for today. And for today, we shall start by topic 1 of advanced financial management. Na sana this is a theory part. So, let's start. And we shall start by definition of advanced financial management. And let's write. It's a discipline concerned with the generation and allocation of scarce resources to the most efficient user within the firm through a market pricing system. I repeat, it's a discipline concerned with the generation and allocation of scarce resources to the most efficient user within the firm through a market pricing system. You are still writing. A firm requires resources in form of funds raised from investors, the fund must be allocated within the organization to projects which will yield the highest return. I repeat, a firm requires resources in form of funds raised from investors, the funds must be allocated within the organization projects which will yield the highest returns. I'm still writing. We shall refer to this definition as we go through the subject. So, we shall be referring to that nini tumeandika sahi. So we have a subtopic, required rate of return. Required rate of return. And we write, the required rate of return into bracket R small I is the minimum rate of return that a project must generate if it has to receive funds. Is the minimum rate of return that a project must generate if it has to receive funds. It's therefore the opportunity cost of capital or returns expected from the second best alternative. In general, how to calculate the rate of return? Required rate of return is equals to risk-free rate plus risk premium. Risk-free rate plus risk premium. We have a small subtopic, scope of finance functions. Scope of finance functions. We write, the functions of financial manager can broadly be divided into two. Namely, the routine function, that's number 1. Number 2, the managerial functions. We start by number 1, managerial finance functions. And we are still writing. Required skillful planning, comma, control, and execution of financial activities. Full stop. There are 4 important managerial finance functions. These include A, or Roman 1 or 1, or whichever naming you want to name it. In number 1, investment of long-term asset mix decisions. Investment of long-term asset mix decisions. We write, these decisions relates to the allocation of funds among investment projects. These decisions relates to the allocation of funds among investment projects. They refer to the firm's decisions on commit current funds to the purchase of fixed assets in expectations of fund future cash flows from these projects. Continue. Investment proposals are evaluated in terms of both risk and expected returns. So we are still writing. Investment decisions also relates to recommitting funds when an old asset becomes less productive. This is referred to as replacement decision. Roman 2, financing decision. Financing decision refers to the decision on the source of funds to finance investment projects. The finance manager must decide the proportion of equity and debt. The mix of debt and equity affects the firm's cost of financing as well as the financial risk. This will further be discussed under the risk-return trade-off. Tutaipata hapo mbele. Division or number 3. Division of earnings decision. The finance manager must decide whether the firm should distribute all profits to the shareholders, retain them, or distribute a portion and retain a portion. The earnings must also be distributed to other providers of funds such as preference shareholders and debt providers of funds such as preference shareholders and debt providers. That is a division of earnings. All right, we share among shareholders, all right, debt providers, and other financial managers. So number 4, or D, or Roman 4, liquidity decision. The firm's liquidity refers to its ability to meet its current obligations as and when they fall due. It can also be referred as current assets management. Full stop. Investment in current assets affects the firm's liquidity, profitability, and risk. The more current assets a firm has, the more liquidity it is. This implies that the firm has a lower risk of becoming insolvent. But since current assets are non-earning assets, the profitability of the firm will be low. Which are some of these non-current assets? Cash, money. So hazina faida yoyote. We have another small topic, routine functions. That in number two. Number two of our managerial, of scope of finance functions. We started with, I said there are two, so we've started with managerial finance functions. Tumeona ziko nne. Then number two, we shall now write about routine functions. And under routine functions, we start by writing, for the effectiveness execution of the managerial finance functions, for the effective execution of the managerial finance functions, routine functions have to be performed. These decisions concern procedures and systems and involves a lot of paperwork at time. In most cases, these decisions are delegated to junior staff in the organization. Some of the important routine functions are: number one, or Roman 1, or A, supervision of cash receipts and payments. B, safeguarding of cash balance. C, custody and safeguarding of important documents. D, record keeping and reporting. We are still writing. The finance manager will be involved with the managerial functions, while the routine functions will be carried out by junior staffs in the firm. He must, however, supervise the activities of these junior staffs. Alright? Hawezi waacha hivyo. Lazima akuwe hapo anawaangalia wanafanya nini. So, another subtopic, objectives of a business entity. Objectives of a business entity. I know you know them. Kwa nini ufungue biashara? Tasema aje biashara yako inaendelea vizuri? What's the sole purpose ya kufungua biashara? Okay, let's proceed by writing. Any business firm would have certain objectives which it aims at achieving. The major goals of a firm are: number one, profit maximization. So unafungua biashara upate faida yako ya kukushikilia kimaisha. Na kama business si necessary ufunge biashara kwa sababu ikupei faida, no, but it's one of the key factors to consider, kujua kama business yako inaendelea vizuri. 2, shareholders wealth maximization. Alright, kama ni kampuni iko limited by shares, so unaangalia tu. Social responsibility. Alright, kwa nini ufungue biashara? Business ethics. And lastly, growth. Alright, so just to touch on those points I've given, let's start by profit maximization. What is profit maximization? Refers to achieving the highest possible profits during the year. This should be achieved by either increasing sales revenue or by reducing expenses. How to calculate profit? Profit is equals to revenue minus expenses. There are some few reasons why profit maximization goal has been criticized. And number one, the subtopic, reasons why profit maximization goal has been criticized. 1, it ignores time value of money. 2, it ignores risk and uncertainty. 3, it is vague V-A-G-U-E, vague. B, it ignores other participants in the firm rather than the shareholders. Kama wewe si shareholder ni hivyo. Haya. 2, tulikuwa na ya kwanza profit maximization. 2, shareholders wealth maximization refers to maximization of the net present value of every decision made in the firm. The net present value is equal to the difference between the present value of benefits received from a decision and the present value of the cost of the decision. We shall discuss it. We shall discuss that later. So, shareholders' wealth maximization helps to solve the problems with profit maximization. This is because, 1, it considers time value of money. It recognizes risk. It is not vague. And number 4, it does not ignore other participants. Okay? And number C, social responsibility. The firm must decide whether to operate strictly in their shareholders' best interest or be responsible to their employers, their customers, and the community in which they operate. The firm may be involved in activities which do not directly benefit the shareholders, but which will improve the business environment. This has a long-term advantage to the firm, and therefore in the long term, and shareholders' wealth may be maximized. D, business ethics. This relates to the issue of social responsibility. Relates to the issue of social responsibility is the question of business ethics. Ethics are defined as the standards of conduct or moral behaviors. A firm commitment to business ethics can be measured by the tendency of the firm and its employees to adhere to rules and regulations relating to 1, product safety and quality. 2, fair employment practices. 3, fair marketing and selling practices. 4, the use of confidential information for personal gain. 5, illegal political involvement. 6, bribery or illegal payments to obtain business. Then we have number 5, growth. Ya mwisho tutamalizia hapo, then tutakuja kuendelea baadaye. Growth. This is a major objective for small companies which may even invest in projects with negative net present value so as to increase their size and enjoy economies of scale in the future. All right? So from there, write a small subtopic there, agency theory. Tutaanzia hapo. So we have just started. Here in topic 1, advanced financial management. Go through those notes. Soma. CPA si ngumu. Just read. Hizi notes nakupea zitakuhelp sana. So let's meet again here, same time, same place, and thank you very much. God bless you. Thank you.